you think they're
Well,
doing it? Yeah.
Apple is not as popular as before now in China. Yeah,
Mm,
so is more shares is now being taken over by Huawei, I believe. Yes.
yeah. That's going to be a big problem for, or could be a big problem for Apple. The Huawei, the flagship phone, their best phone, their top of the range model. How much does it cost in US dollars? Just to compare that to the Apple iPhone, basically, when it comes out. How much does a Huawei cost?
I'm not sure about the latest model yet. I will check and get back to you. Yeah,
Okay,
I'm not
just
sure
to
about
see what the price difference is. If one is like five, because I think the Apple one's going to be well more than $1,000, I think now.
Hi, everyone. We're going live now. Thank you.
Okay.
Good morning. Good morning. How much is an Apple phone? It's cheaper than a Rolex watch, which was, of course, the subject of last week's conversation. Let's kick off this morning. It is Monday, the 11th of September, which, of course, is a big date in the history of the world in recent decades. And to all those that acknowledge that date, continue to acknowledge that date. We offer continued condolence on that. The markets today opening in Asia, in China, a little bit down, a little bit soft, but still firmly above $90 a barrel. Let's kick off this morning with Omar Najia, Global Head of Derivatives at BB Energy. Omar, last week we were here. It was the beginning of the season of the first Monday of September and the beginning of APEC week, a bullish week that saw us go above $90 a barrel with the confirmation from Saudi Arabia and Russia that they would extend their cuts to the end of the year. Your thoughts on the direction of travel now? Are we firmly consolidating above $90 on Brent?
Yeah, I mean, there's not a lot not to like, in the market. A lot of people were looking for basically tops. A lot of people were negative on, cracks, so product against crude, on gasoline, because it was coming out to the end of the season, on gas oil, because, it's gone up too much. I don't know what, blah, blah, blah. But then, prices seem to have consolidated and moved higher. So I think basically expectation is still, I mean, week after week, you get people saying, why is this market so high? But, China's collapsing, we're going to come off, I don't know what, blah, blah, but the market keeps marching higher. There was a bit of news about Russia cutting diesel exports. And I don't think they're doing it because, they have a lack of diesel or a surplus of diesel. I think they're doing it on purpose. I think basically it's, we're in a world now where you have OPEC Plus want oil prices higher, no matter what. So whatever it costs, whatever it does, they will push this market higher. This is what I believe, basically.
Paul Horsnell, Head of Commodities Research at Standard Chartered Bank. Paul, your thoughts this morning in the direction of how much of this market above 90 is the sort of jaw-boning determination of OPEC Plus with their fairly strong supply cuts, or have we got a real demand story here?
Well, we've got a supply and a demand story, but we've certainly got excess demand, strong deficits in the market. I'm talking about more than 2 million barrels a day of excess demand in both August and September. On our balances, we don't get any surpluses until January, and it's very temporary. So I think it's driven very much by the physical markets, very much by a tightening that is actually happening. It's the tightening that some analysts and the IEA, let's give them credit for the balances being correct, have been warning about for months. So I think in some ways, the actual market has run far behind the fundamentals. And this is a delayed response to a tightening that's been going on really for a few months. and we think it will continue. So about now, this is where speculative money might start getting a bit more interested. But what's made this rally, I think, most remarkable is how the speculators have stayed on the sidelines, have been very bearish, as Omar suggested, about the world in general and in China throughout this rally. So very much driven by the numbers.
Well, the whole year, one would say on that, given that the narrative for the year was the recession is coming. And so many missed out on both the equity and the commodities rally.
Yeah, I think that's right, but particularly on the commodities rally, and I think over the past few months on oil in particular. And again, I very much agree with Omar in terms of the market being very quick to take individual elements, so to worry about China, to worry about the US rate hiking cycle, and not do the usual old-fashioned hard work of, okay, what's total supply and total demand? Let's not look at the little bits. Let's look at the whole thing in total, and that's really where the strength of the numbers has come through. It's that throttling back of supply on the supply side, together with demand being pretty good, and then increasing seasonally, creating these large deficits. So very fundamental, and very much, I think, a case of the market being a little bit behind reality.
Well, let's drill down into one of those modular pieces of the puzzle, which is, of course, not an insignificant one, on China demand. Victor Yang, senior analyst at JLC Network Technologies in China. Victor, perhaps you can help us understand the gap, at least the gap in my understanding, that we have continued robust imports into China. Crude oil imports surged to 12.43 million barrels a day in August, the third highest daily rate and 20% higher than July. So clearly imports into China remain substantial, but yet the macroeconomic headlines, even in the green room before we went live, you were talking about the weakness or the sort of vulnerability in the Chinese economy. How do those two things exist? Can you help us understand that?
Yes, well, on the one hand, we have been talking about weak market in China. But when we compare this market to last year, when we had lockdowns often, well, demand has improved quite significantly this year. Say, if we look at PetroChina's and Sinopec's oil product sales in the first 6 months, say PetroChina's and Sinopec's gasoline sales grew by 12% and 17.5% in the 6 months. And their diesel sales surged by 8.2% and 13.1%. So if we look at the data from them, we can see that actually demand has improved quite significantly. And jet fuel demand surged most significantly by over 43%. So
in 2023, year on year.
In the first 6 months of this year.
First 6 months. Okay.
Yes. Yeah. So actually, and the country's crude imports have been quite substantial too. And in the meanwhile, it put some crude into storage in the first 7 months, about 706 KBD.
700,000 barrels a day has gone into storage in the first 6 months.
Yes. So expanding refining capacity, rebounding fuel demand, and stockpiling contributed to the large jump in its crude imports. And in the next few months, as crude prices jump, we may see slowing imports by China. Yes, but not as strong as in the first 7 months, probably. Yes.
So in the context of consumption, the consumption in China, we have data indicating weaker manufacturing, weaker construction. So where is all the consumption coming from? Mainly mobility?
Well, for diesel demand, the consumption is mostly from logistics. And logistics has improved quite dramatically this year. For construction, yes, construction is weak now. So it has kept the growth. But logistic is much stronger this year than last year.
Omar, looking at the market this week, and obviously we have we had the bounce, if you like, from the news last week, as you said yourself a week ago, that if the news came in that we get this extension, we would get a bounce in the oil price. We got it. It seemed to have a limit on it, in the sense that it moved us above 90, but it hasn't moved on from there. What's your technical reading of this sort of trajectory as we go forward? We've had our bounce from the news, but now we're it looks like some kind of a pause.
Well, I mean, you know, I mean, the thing is, I think pretty much everybody expected that these things are expected. So they come up with the news, market goes up, short-term traders come in, sell it, people wait, and then basically trade that's going to hold it comes in and buys, right? So it always happens. It's always the same thing. But
there was some surprise in the sense that the expectation was a continuation month to month. Here they went a whole 3 months, which sort of put an extra robustness in the decision.
Yeah, I agree. I think basically what I mean, you know, the indication from OPEC Plus is they're going to keep cutting. They're going to keep this market supported. They need Brent over $90 plus. And I think, you know, what Paul was saying before, if you look at this period last year, when China was not at all, you know, recovering and all this stuff, prices were the same. So basically, fundamentally, in people's minds, it's been like the market going up in spite of all that stuff. It's been basically like somebody pulling a tooth out. Now, at some point, I'm not expecting the kind of, you know, okay, the tooth comes out and all this kind of stuff. I expect them to kind of start pulling lots and lots of teeth out, because I think the risk here going into the end of the year is that, you know, it's winter. You don't want to be short. There are people on strike. The Russians are cutting diesel. You know, cracks are strong. You know, you could have something blow up in Niger. You could have something blow up in Nigeria. You could have something blow up in Libya. You know, all this stuff. So I wouldn't be. You know, I mean, it's amazing. You come to a seasonally, you know, important part of the year, and you don't want to be short. I mean, unless you're looking to be massacred. I'm not saying that, you know, if you're short, you are going to be. All I'm saying is risk is, to me, very much to the upside. I think basically you might, you know, the selling that we had early last week and the week before on cracks was massive, was monumental. It took the market down from, like on the Q4, down from about 34 down to about 26, 27.
Did we lose Omar? I've lost him on my screen. Yep. Paul, let's go to move forward, and I'm sure Omar will come back. On the point that you made earlier, that the hedge funds and the sort of speculative money may be drawn back into the market. And there's certainly indicators that is underway. Your thoughts on what would be the indicators that would guide that? What would that money need to see in order to sort of be move into a greater velocity?
Yeah, well, I think first thing we'll see, that money is $20 too late. It's been riding the wrong horse really for a few months. I was really using that as Omar used the word despite, and I think that's exactly it. This has been a rally which, for most traders, certainly for hedge fund traders, has been totally unloved. I mean, it's been very willing to join in. And so, is it a good idea to join in a rally when you're $20 too late to do it? I think they're probably only going to start already joining in, through momentum. Momentum traders should come back in, and B, if some of these concerns they have about rate hiking cycles, you know, start to evaporate a bit more. The number of hedge funds these days who do, as I said, the old fashions, let's do supply and demand to try to work out where the price is going on the basis of that. A lot of that has died away. So those guys are coming in. I think a lot of the more purely top-down macro people are still going to stay out of this rally. They're almost too late at this point.
And just to sort of move on from that in the context of the price point, we haven't heard, Paul, any pushback from the consumers in the past. India usually barks a bit when prices go this high. Obviously, the US has on occasion, and especially when the pump price starts to elevate. But where do you think this price point as we move, and if we do consolidate above 90, where does it intersect with the sort of global economic slowdown in economic growth?
Yeah, I think that's why there's very few people talking about 120, 130. This isn't seen as a rally that's just going to continue without those kind of feedback responses. But I think there's enough comfort that the feedback responses are reasonable enough at 90 not to derail the rally. At 95, pushing around 100 again, still not enough to derail. And we're not really looking at that extreme upside. Volatility in the market is very low. Volatility is down to levels not really seen since late 2021. So within that sort of a context, a relatively low volatility market, we are looking at this kind of gradual consolidation of prices above 90 without being too worried about immediate surges up to 110, 120, except in those cases that Omar referred to, if there is further supply risk coming back into the market. So clearly, yes, there is a feedback effect on demand, but again, that's why you do your numbers. That's part of the process, is to build in a demand response to higher prices.
Victor, the question in China, as we look to the outlook for the Chinese economy, is the question around stimulus. The idea that one of the narratives has been that the stimulus or the central policy reaction so far, as we saw in most of the Western economies, there was massive stimulus. I mean, literally, people got paychecks in their post for staying at home on the couch. China hasn't done that. China's stimulus reaction so far coming out of COVID has been relatively muted and in bite size. Do you expect that to change? Is there a silver bullet that the government can use to sort of accelerate to get the Chinese economy back on a track? Is there anything they can do to tackle this, what seems to be a slow implosion of the real estate sector?
Well, I believe the country is under more pressure to push up its economy in the last few months. And one of the measures it can take is to increase exports, including oil product exports. As you know, the government released quotas on 12 million metric tons of oil product exports, gasoline, diesel, and jet fuel at the end of August. So we expect to see for the rest of 23? For the last quarter.
Okay.
And so we expect to see a surge in its oil product exports. And this is quite similar to other sectors too, say try to increase their exports. And this is one way. But as for other large stimuli, we do not expect to see, say, like paychecks, it doesn't work here in China. Well, and so for now,
the leadership of China does seem to be very averse to the idea of handouts, averse the idea of more credit.
Yes, well, it doesn't suit the country properly. And now people are cautious and they lack confidence in the future. So they tend to spend maybe not less, but they wouldn't spend much more than before. So that's one issue. So they're trying to pump confidence into people and try to encourage them to spend more. And as for the real estate industry, well, people are not going to buy houses yet in the near term, not many of them, because they still expect the price to go down. And so a lot of real estate developers are still in trouble. And the government have been trying to well, bail them out, but not really to bail them, but to improve their policies on this sector to make it easier for them to help them sell their houses. And that's what they're doing now.
What about the vulnerability of regional governments? It seems a lot of the debt burden is with regional governments who have mismanaged their sort of property portfolios and find themselves vulnerable. What's the weakness there? What does that look like?
Well, when we talk about this, we had to mention the real estate industry, because in the past, local governments rely a lot on the real estate industry for their development. And now they cannot do that again. So there's a big problem for them. And another one is the pandemic over the past 3 years got them into kind of financial trouble. Some are still in debt. So they are not able to roll out very big stimulus for the local enterprises. That's one of the reasons too. And so now, say, real estate developments are not allowed to cut their prices just as they wish to promote sales, because it can cause a lot of issues, and particularly with the local government. So it's kind of, well, difficult situation for them. So on the one way, people expect prices to fall, but on the other hand, they are not allowed to cut prices as they wish to promote sales. So the local government is now trying to figure out a way to work out this issue.
That is a difficult spot to be in. Let's go to the survey question, which is looking at the point that we're discussing. Can Brent consolidate above $90 this week, even as China macro data continues to show weakness? Yes or no? Can we consolidate above 90 this week, even with the world's biggest oil importer, which is still importing a lot of oil? So clearly there's a disconnect between the macro picture in China and their import appetite. Nonetheless, can it consolidate with the macro weakness? Omar, looking forward from the point of view, you gave us some technicals last week that resistance on the upside, there could be a full pathway above $100 for WTI.
Yeah, I think basically the next target for TI is 96 and change. I like the fact that it's a rally that not many are convinced of. I like the fact that it's contrarian. I like the fact that we've been talking about Chinese macro for about, at least since July, when oil prices were at 67.
July 1980, I think.
Yeah. So all this stuff is, I like, people are worried about, what's the Fed going to do and what's that going to do, and we'll only buy if it's so I like this. I think basically, so the risk to me, if everybody is expecting like, okay, we maybe go down a little bit, maybe we hold where we are, maybe, this kind of stuff, the risk to me seems to be a complete, slam dunk up in your face, simply because it can. Simply because people will be surprised, simply because people will be hurt, and simply because people won't know what to do. I mean, the most beautiful thing is when a market, it's like a herd of whatever it is, cows. They're trotting along happily and eating and all this kind of stuff. But then for no reason, one of them just legs it, and all of a sudden the entire herd is legging it, and nobody knows why. It's just basically they're running.
And
so maybe that'll be the maybe that'll be but I think higher on oil because it can.
Who's legging it, Paul, in the US economic outlook? I mean, clearly the resilience and of the US economy this year has really been the surprise. We started the year with the narrative that it would be the year of two halves with China, and it would come to be the global sort of savior. It's really been the US economy that's been the surprise this year. Does that continue? Is that the golden goose that keeps on delivering?
I think a lot of the forecasts are still a little bit downbeat. But again, go back to it. The year of the two halves narrative was complete nonsense from the start, because that's trying to imply split the oil year by things that are happening in the macro economy. And oil doesn't work like that. Eventually, oil reasserts itself. It may take a little bit of a helping hand from producers, but that's why that two halves didn't work from a macro point of view. And likewise, you take that, then okay, a little bit of slowing in the US economy, that doesn't really matter very much in terms of the market dynamics that Omar just went through. I think the key point there is precisely as he said, a totally unloved oil rally, partly unloved because of those views about the US macro. But when it comes down to it, US macro is not the key driver here. It's in people's heads that it should be the key driver, but it isn't. It's been driven much more by, again, those that excess demand for which the US macro is only influencing a small number of players. And those players have just been on the wrong side of it for really a whole quarter now.
When you think of the sort of macro narrative and however, I mean, we're seeing this, I asked Victor about the sort of gap between the perception of Chinese economic weakness and yet they're having record import levels. What's your own sense of that and the elasticity of oil demand despite the macro? You know, we have, you know, global economic growth, IMF and World Bank forecast, they keep revising down, and yet demand seems to be holding.
Yeah, I mean, I talked about those. Sorry, I can just jump
Please.
in on the demand side. We're actually very downbeat on demand. We're on the low side, but happy for this year, putting China at just about 800,000 barrels a day growth. You know, the IEA, some of the higher forecasts are more like 1.2 million barrels a day. And I think that's the key point about how strong the market is overall, thanks to the supply side, is you can put in a very weak China outlook. You can put in a fairly anemic looking global demand outlook overall, and still it comes out looking quite strong. So it's, you know, the oil price is about supply and demand. It's not about whether demand is speeding up or slowing down. It's where it is relative to supply. And so that's, again, back to Omar's caution. If it turns out we're wrong and demand is much stronger than we think, then again, that's further upside. So again, back onto that, not trying to drive the view by just a view on China macro, US macro, China demand. We think China demand is, you know, is slowing, but it's in a slower gear, but that slower gear isn't reversed. And some of the stuff I read almost reads as if China's demand is going to fall. It's not going to do that. It might just be a bit slower.
Victor, last word with you, survey result. In terms of the outlook, so there's Brent can consolidate. Yes, it can and is, I suppose, is the answer. Victor, the outlook of going forward into the fourth quarter, into the Chinese New Year, demand consumption tends to rise. Are there anything in that sort of period of time? How do you think this trajectory? You'd indicate that you would expect imports to drop off a bit, but only because of the sensitivity to higher price. On consumption and the economic growth for China, do you expect the 5% target to be hit?
Well, we still expect the government to achieve its target of 5%. Yes. Well, there has been high expectation of this market this year, so that's why they keep saying it's weak. Even if gasoline jet fuel demand has surged year on year, but when we look back into last year, when we had lockdowns open, say Shanghai under lockdowns for 2 months, and a lot of other cities were half under lockdown, so logistics was largely stagnant at that time. So when we compare this year to last year, we can say it's much better, but it's below expectation. That's why they keep saying it's weak. So we should look at this one in different perspectives, perhaps. Well, in the last quarter, we expect diesel demand to recover further, but it's still below previous expectation, perhaps. And jet fuel, gasoline demand has basically been back to the pre-COVID level. And in the last quarter, the country's crude imports might be slowing because of much higher prices. But in the meantime, its exports, oil product exports, will surge to give a boost to its economy. So this will continue to bolster its crude imports.
I wanted to get your view, just to pick up on that, the point of further exports. You said obviously was announced the increased export quotas for the fourth
Yes.
quarter. Do you expect that to continue to be a continued feature? We've had the Chinese, the CNOOC research show that in China, there's already reached peak oil demand, gasoline demand. Your thoughts on China becoming exports, China products becoming, given obviously the massive refinery investment in the country, is this going to be a consistent feature, greater and greater exports of products out of China?
Well, we do not see over the long term, but in the next 2 years, it can still grow. Say next year, we do not see gasoline demand peaking yet. We expect it to peak around 2025. Yes, we can see a lot of conventional fuel cars have been replaced by NEVs, but the sales of conventional cars are still growing, say like by something like 2% this year. And jet fuel demand is still growing. Diesel demand tends to stabilize in the coming 2 years also. But the country's refining capacity is still growing. A few refineries are coming on stream from next year to 2026, including joint ventures between Saudi Aramco and Nolimco and Sinopec. And so we expect the country to still encourage exports to some degree to next year. Yeah, but not in the long term, because it doesn't fit in with the country's policy on energy consumption.
Okay, well, we'll have to leave it there. Brent crude trading this morning in Asia, a little bit soft, but still firmly at $90.50. Thank you so much for joining us this morning. I would like to obviously thank Omar Najia, Global Head of Derivatives of BB Energy, always anchoring Monday mornings. Paul Horsnell, Head of Commodities Research at Standard Chartered Bank in the UK, and Victor Yang, Senior Analyst, JLC Network Technology in China. Thank you guys also very much. Have a great week and look forward to catching up every morning at 10:30 UAE time. All the best.
Thank you.
Thank you.
Cheers.